So our financial 15 this week, I'm going to make an adjustment here just so I can draw on my whiteboard effectively. But I explained to you how I came about this, but I'm just going to say it again because we do break up our videos. We have the full weekly webinar, and then we also have these financial 15 videos on YouTube as well and on our website. So if you're just joining us for the financial 15, I talked earlier in the weekly webinar and in the weekly webinar video, which is much longer. It usually runs about 45 minutes to an hour, but I go over some great IRA distribution information from the Slott group, which I'm fortunate to be a member of. And I go over some market analyses. And then we have this section here called the financial 15. And what I was talking about earlier, and I'll just remind you folks, is I was doing my own New Year checklist and planning like I typically do in the beginning of the year. And I thought this would be a really good thing to share, I think. You can let me know. You can give me feedback with you folks. So, it's something I want to develop, as I mentioned, to send out to clients as well, because I want, there's some things that you just may not be considering, just like when we go through our financial planning process. And, we don't, if someone says to us, oh, I want to spend $7,500 a month, we don't just take that and write it down and say, okay, that's our objective. We go through a process of uncovering your real expenses. And I have here we go again. So I have a video about that, and that is real expenses. And I'll list that here in the comments, or not in the comments, but in the description. But that's an example of digging in and really identifying true cost of things or issues you may not be considering. So going into 2024, I'd like you to take a look and see, okay, this would potentially be happening to me, to me, and I want to properly plan for it rather than waiting until November or December and say, oh, geez, this happened. Now I have to address it. So I think a year-end checklist and a New Year checklist is probably a good thing. So the first thing on my checklist, and again, this is not exhaustive. And if you are just joining us for this Financial 15, please hit the like, subscribe, and notification button so that you don't miss any videos going forward. So again, this is not, I'm certain there's things on here that you think that might be helpful on this checklist or should be on the checklist, but this is what I came up with and the things that I go through. So let's look at the first one. Do you reach a key age in 2024? So what are some of those key ages? Well, the first is age 50. Why is age 50 important? Age 50 is important because if you're contributing to IRAs or retirement plans, you have catch-up contributions after age 50. So you can see here, they can be significant. So this is a table I captured. But you can see in 401ks, 403bs, and 457 plans, I'm right here, your catch-up contribution is $7,500. So if you are not ready for that in the beginning of the year, it is with retirement plans, if you don't realize that you have the ability to contribute more, right? These are 2024 numbers. So this is 2024 retirement accounts and retirement plans, contribution levels. So this has gone up. And then if you go... If you suddenly realize, say in September, that, hey, I could have put in another $7,500, or I'm still using 2023 numbers on my deferral, that is not a 2023 number, I'm just giving you an example, then you may not, because it's a salary deferral, you may not be able to just say, oh, you know what, I make up the difference in that. There may not be enough time, or you may not be able to reduce your paycheck that much, because a salary deferral is they take the money out of your salary and they put it into the retirement plan. You can't just write a check into that retirement plan. So that's a really important one, because you might want to take advantage of that. And simple plans have catch-up contributions. SEP IRAs have catch-up contributions. Of course, solo 401ks, traditional IRAs, and Roth IRAs have these catch-up contributions. There's some leniency with these two, because you have up till the filing deadline of the following year to make these contributions. But these anything above this line, this all has to be done by year end. So if you reached 50 or are reaching 50 this year, you might want to take a look at your contributions. And if you contribute to a 401k, you may want to just increase those contributions anyway. Age 55. So that's the first check. Age 55. Well, that's increased contribution limits to HSAs. What's an HSA? A health savings account. So if you have a high deductible plan, I'm good. If you have a high deductible plan, you likely have access to an HSA. HSAs are excellent investment vehicles and savings vehicles because you get a tax deduction by putting money into the HSA. And if it's used for qualified medical expenses, then you don't pay tax on that. Now, if you can, I would suggest that you wait until retirement to use that HSA. Many people will fund their HSA with whatever amount and then take it out immediately to help pay for those medical expenses. And that's not the best way to handle that, in my opinion. My opinion is that you let those funds grow in those HSAs. Find a good investment vehicle. My HSA, I can buy stocks, bonds, and whatever I want, mutual funds, ETFs in it, and not really whatever I want, but pretty much whatever I want. So my HSA is fully invested, and for most people, theirs should be. It shouldn't just sit in a savings account, in my opinion. It should be fully invested, and it should be for your retirement, not to be used as a pass-through on the existing year. That should be a consideration anyway. But you have increased contribution limits to your HSA, and I can share that with you now. But that's you can see that's $1,000 more over age 55. Yeah, I'm sorry, that's $1,000 more over age 55. So HSAs. So that has increased this year. For single filers, this is now your contribution level is $4,150. For a family, that's $8,300. Again, you get a tax deduction for that. That money grows, comes out tax-free as long as it's for qualified medical expenses. And if you're over age 55, you can contribute $1,000 more than that. So that's your HSA, and that is your age 55. 59 and a half is a big age. Why is 59 and a half a big age? 59 and a half is the age that you potentially have access to your 401k or other retirement plan, 403b. That's because the IRS says that at age 59 and a half, you can have full access to your 401k to roll over to an IRA or either one. So your 401k to roll over to an IRA. The reason you may want to consider that, and there are considerations to make, whether you roll over a 401k to an IRA, whether it's a traditional IRA or a Roth IRA, whether it's a 401k, a Roth 401k or to a Roth IRA, there are certainly considerations to make. But you may want to do that. You may want to roll your 401k, your traditional 401k to a traditional IRA so that you can do Roth conversions. You might want more investment choices. You might want investment advice. There are different reasons for that. The IRS says that you can do that. There's no tax on that. There's no penalty on that as long as it's done correctly. And it's actually really hard to do incorrectly, but some people still do it. But as long as it's done correctly, there's no tax on that. You just transfer your funds from a 401k to an IRA. And then you can do what you want with it. The IRS says you can. Your plan might be more restrictive. So you got to check with your plan to make sure that you can, in fact, roll a 401k into an IRA. But age 59 is the triggering age for that, per the IRS. Again, your plan could be more restrictive. I don't know why they still are. It seems like huge liability to me. But age 59 is important. Age 65 is important. Why is age 65 important? Medicare and IRMA. Oh, I should have added a couple ages in here. 62. I should have added age. Well, this one's different, but certainly 70. That would go here. So 60. Let me go back to 65. So that's when you are eligible for Medicare benefits. So there are some requirements around Medicare election that you should be aware of. It's not an area of course we consider Medicare costs and IRMA costs, but I have an excellent resource for a Medicare benefit. If you need that resource, you can reach out to me at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. I'm happy to help you with that. Introduce you to that individual. But Medicare is a big, important decision, and you should talk to a qualified expert about that. IRMAA is income-related monthly adjustment amounts. I certainly have a video on that I'll include in the description, but that is a surcharge on your Medicare costs, and that is all determined by your modified adjusted gross income. So if your income is higher, and it doesn't feel real high, but as your income grows higher, you get more surcharges, and they can get quite expensive. So if you're eligible for Medicare and you're receiving Medicare benefits and paying for them, you also have to learn about IRMAA. Don't let it surprise you. A lot of people are surprised by this. So 65 is a big year. 70 is a big year. 70 is the maximum credit age for Social Security. So we'll add that to our checklist. Maximum credit age for Social Security. Now, deciding when you're going to elect your Social Security benefits is a big decision. It starts at 62. It goes all the way to 70. But there are many considerations to make in that decision. And we're fortunate that we have one of the top experts, I believe, in the country, Heather Schreiber, who works with our team, who helps us analyze options, Social Security options for our clients. So that is a big decision. You've not just look at the amount that you can get out of the Social Security Administration, but you also have to look at your cash flow needs and your tax situation and all those different things. But certainly ages 62 to 70 is Social Security. And then we have 73 is now the RMD age. Age 73 is now the required minimum distribution age. Let me say that again. The required minimum distribution age for your IRAs and 401ks, traditional IRAs and traditional 401ks, is now 73. It is not 70 and a half. I know you've heard the age 70 and a half. That changed a couple years ago to 72, but it is not 72 anymore. It is now 73. So 73 is the age that you must begin taking your required minimum distributions. It is required minimum distributions has become, in my opinion, one of the most confusing parts of the tax code. And it also holds the most expensive penalty, which is 25%. And it can be reduced to 10%, but 25% of what you should have taken out of your IRA account, that is, or 10% of what you should have taken out of your IRA account. So pay attention to age 73, required minimum distributions. All right. Also, we talked about contributions to retirement accounts and retirement plans. These have all gone up this year. So IRAs and Roth IRAs are now $7,000. With the $1,000 plus the $1,000 catch up if you're over 50. So we talked about that, but this is just a look at some of the increases for 2024. But you want to be aware of those increases so you can plan accordingly. And we talked about HSAs. Now we look at, and I did that. I don't think I was cutting anything off. Then we look at what your anticipations are for the year. Do you anticipate changes to your job or jobs? Right? Maybe you're married and you and your spouse are both going to retire or just change jobs. So retirement it could be different. It could be that you're completely stopping working. Changes to jobs could be you're getting a larger position. You're going to be consulting. You're going to be working part-time. There could be a lot. So is that something that's part of your plan to this year? Of course, you may end up in that situation. It may come suddenly in July and you didn't anticipate it for this year, but it could be something you're thinking about. So do you anticipate changes to your job or jobs? Do you anticipate retirement, whatever that retirement looks like to you, whether it's working less, not working at all, whatever? Do you anticipate doing that this year? If you do, there are certainly some planning steps you should be taking now to prepare for that. How about sale of property or relocation? Do you anticipate selling your home, investment properties, or relocating? This is something that you should be considering now in the beginning of the year and start planning for it, even if it's not going to happen until the end of the year or the middle of the year. Start having those discussions now. How about major expenses? Weddings, mitzvahs, other events, education, that's on top of my mind right now. I've got 2 kids in college, or one in, one going, but, all these major expenses, you should be fleshing these out at this point in time, writing down, okay, I could potentially have this. I may need a new car. Geez, we might need a new roof, new heating system, whatever it might be. I was talking to somebody yesterday and they said, my heat went out. There were 3 things. His power, something happened with his power, his heat, and something else all at once. And that's a lot to deal with. But major expenses for the year. Do you have anything planned? Major expenses. How are you going to handle that? Charitable contributions. So QCDs are now, that's qualified charitable distributions. I, of course, have a video on qualified charitable distributions. I'm going to write that down. But QCDs under the Secure 2.0 Act are now adjusted for inflation. If you're going to be making charitable contributions, and certainly if you're going to be using the QCD provision that allows you to take money out of your IRA, send it directly to a charity without passing go, so to speak. It goes right to the charity, so you don't have to pay tax on that. But there are requirements around that. So that is something you want to plan for. And then you want to schedule. Like I told you, I was scheduling my doctor's appointments and things like that. You want to schedule your financial planning meeting. You should be reviewing your financial plan every single year. You all know I say this. Sometimes, we have clients January 1 knocking on our door saying, when is my financial planning meeting? And sometimes we have clients at the end of the year, we're saying, please send us the documents back that we sent you. But you should have that financial planning meeting scheduled because the year gets busy, whether good busy or not so good busy, and you want to make sure that those things are on your calendar. Account reviews, whether you review them yourself or you're working with a professional, review those accounts. I told you, I am not, I don't know if you've heard this from me before, but I am not of the mindset that you should never look at your statements. Financial advisors say that, and I will just say I think it's irresponsible, especially during bad markets. You want to look at your statements and you want to have account reviews. And if you're up, you should listen. Nobody expects you individuals to have the same knowledge of investments and the fundamentals that we do, right? But you should have a general idea of, or ask questions. Okay, I see that this account is down X percent. Why is it down X percent? You ask that question. Or, hey, this is up quite a bit, or it's up at all. Why is that the case? No one should be afraid of answering the question why. So account reviews are important. Tax filing. Don't wait till the last minute. Wouldn't it be nice to reach out to your accountant, your tax preparer today and say, hey, I just want to make sure I'm on your calendar for our tax filing because I know April comes quickly and I know you get very busy. So set up that tax filing appointment now and start getting your information together. And then estimated taxes. Don't let this sneak up on you. If you're doing Roth conversions or any kind of tax planning, or if you're still working and you need to make estimated payments, you've got some deadline. You got one coming up next week, and then you've got some deadlines throughout the rest of the year. So schedule those estimated taxes. All right. And I think that covers our checklist. So that's a good start. Again, I added 2 things while we were talking, so I'm sure there's other things that you can add on. But I want to get your mind working, and let's start with the planning process and checklists and getting all that information, and that positioning is the start of the planning process. So I hope that was helpful. So that's it for our webinar today. We will not have a webinar next week. We'll be back the following week. I'll be on the heels of returning from a trip out to Arizona to see our Power Zero friends, and I'm fortunate to be asked to speak at the Power Zero conference this year, so I'm excited about that. But so I'll be coming back, but we will have a webinar as long as there's no issues as far as flights on the 23rd. And I hope this was helpful. I hope you enjoyed it, and I hope you have a great week. If you reach out to us, if you need to reach out to us to schedule an appointment with me or have questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com, and you can find a lot of great information, I think, at attleborowealth.com. Folks, we'll see you next week, and have a great week. Take care.